Good morning, traders. Welcome to the live stream. My name is Charles Gough. I come from a community called Pirate Traders, where we are focused on the ES, the NQ, and how they move through the two-way auction process. If you are joining us this morning, please smash that thumbs up button. Those likes really help out. You know, Bookmap is kind enough to put this together for you guys, so you could be kind enough to push one little button for Bookmap. Let me get them thumb. All right. Well, I know why you're here today. You want to hear my predictions for where I think the market is going to go. And it's a little bit tricky this morning to figure out exactly where the market is going to go today. I am bullish. I would describe myself as believing that the market is going to go higher, likely to test the all-time highs this week. Not necessarily today, but you know, in the next couple of days, I think we want to head up and try to get above 64, 68. See what happens when we get up there. But there is a bit of nuance to add to it. Last week was very, very tricky. Okay. When the market is very, very tricky, we know that is often because of the options market and a sort of pinning effect that can happen within the options market. Okay. Last week we had days where we created P-shaped profiles. That's a sign of momentum up, but then immediately followed it with a B-shaped profile, which is a sign of momentum down. You had overlapping to lower value, which is a sign of momentum down, but you had one time framing on the daily, higher highs and higher lows, which is a sign of momentum up. Really unusual to see. And then again, P-shaped profile, sign of momentum up, you know, overlapping to higher value, sign of momentum up. Next day, huge gap up, confirmation of the momentum up, that then completely sells off, makes a B-shaped profile, overlapping to lower volume, whilst still one time framing higher, which is bullish to see. And then, of course, on Friday, we had another P-shaped profile that once again made higher highs, higher lows, and had value higher. So the fact that we are one time framing, the fact that we're making these higher highs and higher lows each day is a sign to me that the market has momentum up. Okay. When we look at the when we look at the market on a weekly time frame. So if we go to the candlesticks and we make them weekly candlesticks, what does it look like the market is doing on a weekly time frame? It's imbalance, right? It's going sideways. That's what it's doing. It's trying to decide if it's going to go up or go down. And this happens. The market can go sideways sometimes for months. Okay. But once it breaks out, it can get excess. It can get momentum in a certain direction. And that can happen two ways, right? You can balance and then you can get momentum up, or you can balance and then get momentum down. Right now, we're just still in balance, right? So if I know that both of those things are true, if I know that on a daily time frame, the market is continually working its way higher, whilst on a weekly time frame it's in balance, the most obvious place the market is going to go is to test those previous weekly highs, which are between, hard to have an exact level, but it's going to be somewhere between the area of around 64.50 and the all-time high, 64.70. Okay. Well, 68. So that's basically the range that is the weekly highs. So the highest probability, Monday morning when the opening bell rings, if we had a week like last week, is that we are going to continue up until we get to those weekly highs. Then the market will turn around and come back down. Now, it doesn't have to, because when the market is in balance, it can reverse anywhere, but that is just the highest probability, the most likely scenario for today. So that alone makes me bullish this morning. That alone makes me think the market wants to, at the very least, head to the overnight high. That is the high that it made this weekend at 64.29. So that is my target for today, where I think the market could go today. But I just have to be cautious because of all this weird behavior last week where the market made a P shape and then a B shape, and then a P shape, and then a B shape. If that trend is going to continue, guess what today will be? A B-shaped profile. Today will be another day where the market sells off into the lower end of yesterday's range and then goes sideways like it did on this day and like it did on this day. So I am bullish. There's no doubt about it. I am just cautiously bullish. So what do I mean by cautiously bullish? I mean, I don't feel any need to force trades. I don't feel like I have to go long right this minute just because I think at some point today we're going to get to 64.30, right? I don't have to go long right now. I can wait. I can wait until, one, I'm confident that we are definitely going to that overnight high. Or two, I can get an entry with a very good risk reward. So for example, if the market were to trade down into support inside yesterday's range, let's say we got some support right here around 64.01, right? So let's say the market is trading down into that support. I'm watching how the market gets down there. As it pushes lower, the tempo is slowing and slowing and slowing. The ranges are getting smaller. I'm seeing the ticks starting to reverse and go up. I'm noticing that whatever behavior has been taking the market lower in terms of order flow is suddenly changing. You know, maybe down there we start to take out some big stops. Maybe down there we had liquidity below price that was pulling price lower, and that liquidity starts to disappear. When I see indications, you know, down inside yesterday's range of support, that is a great place to go long because my risk to reward is much better than going long right now, right? So I'd rather wait until I get a better entry with better risk reward later on in the day. I don't need to force a trade right at the market opened. Or the market might open, it pushes above yesterday's high, and then it starts to turn that area into support. Okay. Well, if I start to see support around yesterday's high, around 64.20, well, then I can trust that the probability of the market going to the overnight high is significantly higher. So then I can get into a trade going long around Friday's high to the overnight high as a high probability opportunity. Does that make sense? So I am bullish and I think we're going to the overnight high, but that doesn't mean I have to be in a trade first thing this morning when the opening bell rings. I want to wait till either that trade is such a high probability of working that I just can't let it pass me by, or it's such a good risk reward that I just can't let that pass me by. That is trading. That is what real trading is all about. It is not about just guessing, is the market going to go up or down, and then getting long or short because you have an opinion. It is about starting with an opinion and then waiting for a high probability or an asymmetric opportunity in the market to actually enter that trade. So I teach all of this and more in my Mastery of Markets and Minds workshop. If you're interested in learning about this, head to marketsandmind.com and you can learn about it there. Essentially, I've got a workshop coming up in about a month. It starts September 8th. This is a live workshop. I teach over 2 weeks. So it's 10 4-hour-long sessions. Yes, it actually takes that long to teach all of this. It's not something I can teach you in the next hour during this live stream. It is a lot of information that I have to unload. I basically equate this to the equivalent of a college course on trading. It is all encompassing. Okay, so you're not just going to learn, you know, how to read the auction process, how to use Bookmap, how to use market profile software. You're also going to learn, you know, how to find setups, how to develop setups, how to adjust as the market changes in real time. You're going to learn about your own psychology. Okay, you're going to learn about specific trading, you know, as day trades versus swing trades. You're going to learn about how you develop your edge and you constantly improve over time. You're going to learn what my personal trading setups are. You're going to learn about differentiating between technical and emotional problems as a way to improve upon your trading results. You're going to learn to develop habits and routines and mindsets that can all increase your success as a trader. This course is designed to basically take somebody who's an amateur and turn them into a professional. Now, that doesn't mean the day you finish the course, you're going to be a profitable trader. It doesn't work like that. That's like saying if you went to my basketball camp, the day the camp is over, you're going to be an NBA basketball player. That's ridiculous, right? You're going to still have to put in a lot of work and a lot of effort and really develop a skill, a complex skill over time. But this will be the map that you will use to do that. This will teach you what that process is, what you need to do. So every day when you sit down in front of the computer, you might still have work to do in terms of developing the skill of trading, but you will know exactly what to do. You will know based on your results how to make adjustments and how to improve. So if you can't watch the workshop live during the sessions, All of the sessions are recorded, and you can watch them as much as you want for up to a year after the course is over. So you can go back and rewatch them and rewatch them. If you buy it now, it's $75 off. Okay. If you buy it now with the promo code Bookmap, it's $75 off plus an additional 10% off of that. That's the best deal that you are possibly going to ever get to buy this workshop, and it only lasts until Friday. So if you are watching this live stream and you are thinking it is time for me to invest a little bit of money into learning what I need to do so that at the very least I know every day when I sit down in front of the computer and I start trading, I am at least doing the right things. I am on the right path. I am on the path to success. Otherwise, you're probably going to be spending years treading water trying to figure it out on your own. So once again, that is marketsandmind.com if you are interested. Any questions on TA for today? Any questions on what we think the market is going to do? Rich is here. Good morning to you. DNK in the house. Welcome, welcome. Billy K is here. Percy is with us. Crypto Rider. Mark and Will. Good morning and welcome. If you are watching this from the Bookmap Discord, you can head to the Futures-Charles tab, and you can leave your questions and comments there, and I will do my best to respond to them in real time. Speaking of which, Hatrick is here. Good morning to you. I can see Does Man is typing something in the Discord. Good morning to you as well. Raphael is here. Welcome, welcome. Okay, so you're saying, I hear you, Charles. You're bullish today. You think the market's going to at least the overnight high, if not much higher. But you're cautious. You're not forcing trades first thing in the morning because you know the market could potentially have a pullback since that's what was happening all last week. What are the sort of levels that we should watch today to get an idea of what's happening? Well, we still have, 17 minutes until the market opens. So the first question will be, do we open with a gap up or not? Okay, we're right on Friday's high, so it is very possible that just a minute or two before the market opens, we may poke up a little bit and get a gap up. If we poke up a little bit, we want to see the gap fill first thing. So we want to see the market come back to Friday's high at 64.19. We want to see them then turn that area, we'll say anywhere above 64.16, into support, and then turn around and head for that overnight high. So if we open with a gap up, the market fills the gap and then finds support, it is bullish to get to the overnight high around 64.30. Okay. If the market opens with a gap up and it cannot turn that into support, that is bearish to come down and test the overnight low around 64.09. Okay. Or 64.08. So if we open with a gap up, it's whether or not we can turn Friday's highs into support that tells us whether the next move is up or down. Okay. If we open inside Friday's range, it will be the area between Friday's high and whatever is the overnight low. Again, currently 64.08, but we've still got plenty of time for the market to make a new low. But, if we were to open right now, it would be a chop zone between this area. So we would just let them go up and down in here as much as they need to. If they got above yesterday's high and turned it into support, we'd be bullish for that move to the overnight high. Or if they got above yesterday's high and couldn't turn it into support, we'd be bearish for that move back down to the chop zone low. Same thing at the overnight low. If they got below there and turned it into resistance, we'd be bearish for a pullback. Or if they failed, we'd be looking to come back up and test Friday's high. But in between those two, it's too much of a guess. There's too much uncertainty to know for sure, which is why we call it a chop zone. A chop zone. So right now we have the bracket bots on the market. If we're looking at the order flow, if we're looking at the Bookmap software, we can see that there is some sort of machine that is keeping orders, a little bit above and a little bit below price. And as price moves, they just move those orders up and down. those should disappear. And it looks like it may have literally just happened. They heard me talking about it and they were like, shit, Charles is talking about it. Turn it off. Yeah, so generally these bracket bots disappear about 15 minutes before the market opens. So they are actually turning off right on schedule, which means from here on out, we can trust the liquidity nodes much more as potential targets for price. That is so funny that they turned them off right when I talked about it. Captain NG in the house. Welcome to you. Alyssa is here. Good morning. Good morning. Tim is with us. Welcome, welcome. If you are watching this for the first time and you don't understand what I'm talking about and you're like, bro, what is a P shape? What the what? I am so confused. Why are you picking those levels? You know, if you have any questions at all, please jump in the chat and let me know. Does Man from the Discord says, I was wondering what you think about the overnight high not holding above the value area high of July 31st. Personally, I'm in balance till the high is broken. So I don't really think about previous value areas in that sort of way. That is we were actually ironically just talking about this on Friday in the brigade. That is a very old-fashioned way to look at value areas. So back in the day, the value area, for those that don't know, are these blue boxes that you see in the range. That basically represents 70% of the day's range. So that is where a majority of the time and volume was brought in, is in that area. And that's very important because as that changes, you can rely on the information much more, right? Price is just an advertising mechanism. This is what we learned from Jim Dalton, that price can go up and down and up and down, and it doesn't mean anything. Price going up doesn't mean it's going to keep going up. It also doesn't mean it's going to come down. Price can go up and then just keep going up, or price can go up and turn around and come back down, right? Price doesn't mean anything. It's just an advertising mechanism. Price moving up or down is just what gets people to go long or short. It's what gets people to trade. It gets them excited. It gets them feeling like they're going to miss their chance. It gets them to do something, but it doesn't really mean anything. Whereas that value area, that blue box, that represents 70% of the day's trade. So if that blue box is moving around, you can trust that people really are changing their minds and getting more bullish or bearish, right? If it's moving up, they're getting more bullish. If it's moving down, they're getting more bearish, right? Now, last week was a terrible example of this, as we started the stream talking about. It is really unusual to have, value higher and then you go lower the next day. It's pretty rare to have value overlapping to lower and then you go higher the next day. And we had a lot of chop back and forth with that last week, but it happens, especially when the market is in balance, which it is on a weekly time frame. The market is in balance, so it's normal to get a lot of reversals that don't make a lot of sense. But when you have consistent moves in value, so let me just, zoom back here a little bit and we'll find some examples of this. You can generally count on the market making new highs or lows the next day based on changes in value. So for example, from this day to this day, value was higher. So you can assume the market is going to make higher highs the next day. What did it do? It made higher highs, right? Well, that day, value was inside the previous day's range. So that's neutral. It's not giving us a clear signal. Same thing the next day. Value inside, that's neutral, not giving us a clear signal. Next day, values overlapping to lower. That's a little bit bearish. Increases the odds we'll make new lows. We did not the next day. That day after that, value was overlapping to higher, increasing the odds. We will make higher highs the next day. And we did. The day after that, the market had higher value, increasing the odds. We'd make higher highs the next day. And we did. That day, we had value overlapping to higher, increasing the odds. We'd make higher highs the next day. And we did. Okay, so that day had lower value. Increasing the odds we'd make a new low. We did not. The day after that, we had overlapping to higher value, increasing the odds to make a higher high the next day, and we did. Overlapping to higher value, higher highs, we did. Overlapping to higher, we did. Overlapping to higher, we did not. Okay? Overlapping to higher, we did. Overlapping to lower, telling us we're probably going to make lower lows. We did. Overlapping to lower, telling us we're going to make lower lows. We did not. Overlapping to higher, we made higher highs. We did. So I could just sit here and go through, higher value, higher highs, higher value, higher highs, higher value, higher highs, higher value, higher highs. Higher value, no higher highs. Next day, still had higher value that day, higher highs. So you can go through this, and you can just sit here day after day after day and monitor this. And what you will find is most of the time, 80 to 90% of the time, if the market has higher value, you will make a higher high the next day. If the market has lower value, you will make a lower low the next day. The times where they don't work are when the market is in balance. It's when the market is going sideways and it's just chopping around. Then you might have value kind of all over the place. What I do not use value is saying, oh, if we, re-enter this day's value on this day, it means we're going to go to the opposite end. Or if we re-enter this day's value the next day and we can't get to the opposite end, it means we're going to head all the way down for this day's value or something like that. That used to be very doable. If we were going back 5-10 years, those types of patterns were very reliable. Nowadays, I do not find value area highs or lows to be support or resistance, and I don't find that re-entering or failing to re-enter them means anything in particular has to happen. So to answer your question, the fact that over the weekend they couldn't stay above this value area high doesn't mean anything to me. We could still open today, push above yesterday's high, find support, break that overnight high, find support, and head to all-time highs. That is a scenario that could happen today, regardless of the fact that we couldn't stay above that value from that day. I just don't take that into account at all at this point. The only thing I'm looking at today in terms of value is what was Friday's value in comparison to Thursday's. The fact that Friday's value was higher tells me what? We're likely to make higher highs today, right? We're likely to, at the very least, get above Friday's high, which obviously doesn't seem that difficult since we're dancing right on it right now. Good morning to Trader. Welcome, welcome. Captain NG says, do you use GEX levels? Boy, it's funny you should ask that. We've just started looking at those last week. If you look over here in the Bookmap, you'll see this column that says CLN in the middle. These are some levels that have come from SpotGamma that basically are potential support or resistance levels based on options order flow. So we keep an eye on those when the market gets to them, essentially as potential magnets for price to get to if it's heading in a direction of one of these. And then also as support or resistance when the market gets there. So for example, there is a call wall just above us around 64.24. That is also the combo L1. So that tells us that there's a lot of resistance just above Friday's high, right? That we're going to push up in there and we're probably going to grind for a while. So hence why we don't need to go long right now to get to the overnight high. We want to get above yesterday's high, let it grind, see if we bring in support. If we do, then we take the target to trade up to the overnight high. Ghost Trader in the house, good morning to you. We got 5 minutes till the market open. Let me know what your questions are. Ask now or forever hold your peace. Well, not forever. You can ask questions whenever you want. Just now's a good time because we're waiting for the market to open. No questions from the chat. Just waiting for the market to open so something can happen. What's it gonna be? Lucas says, another day at the big casino. All right, Lucas, that's what I'll talk about. Why is the market a casino? Right? Why do we think about the market as a casino? Well, there's two different ways we think about the market being a casino. One, the results are always random. Okay? When you go into a casino and they, roll that ball onto the roulette wheel, it could land on any of those spots, right? It's totally random. It's a matter of the wind, the air pressure in the room, the gravitational pull, the force that the person, pushed the ball and pushed the thing. All of that is constantly changing factors that make it so that ball can land in any of those spots. Okay? That is the way the market works. The market's moves from day to day are completely random. It goes up, it comes down. It doesn't really mean anything. And there are a million different factors that, affect how the market will move and what it will do at what different levels. So then you think, well, does that mean TA is bullshit? Does that mean that none of this stuff really works, that we're just guessing because the market is random? And the answer is yes and no. The yes part of it is no matter what TA tells you, the market can still do anything. So for example, when we talk about like order flow using Bookmap, generally the way we think about order flow is where is the liquidity, right? Where are the orders that are currently sitting in the order book? If you've got a large node of orders, that becomes a magnet. Now there's two different ways it can become a magnet. It can become a magnet that pulls the price to it, or it can become a magnet that pushes the price away from it. It can have both effects, but you can trust day in and day out, no matter what's going on with the market, when you start to see big nodes of liquidity pop up, they will act as a magnet. And you just have to watch what price does in reaction to figure out, is it a magnet pushing price away or a magnet pulling price towards it, right? That being said, you can get a magnet. So for example, they were adding more liquidity right here. What did price start to do? It started to go away. So what should the market do right now this minute? As soon as they disappear it, turn around and start coming back up. Oh, look, now they're adding it again. What should market do? Turn around and go back down. So you can think about it in that context, and that will give you an understanding of what the market is doing that will be right most of the time, but not always. They may, that liquidity might be acting as a magnet pushing market away, and then out of nowhere, the market comes back up and fills that liquidity, right? So the things that we look at in TA are just a way to display totally random information. But it does it in a way where we can have an edge. What is an edge? An edge just means within the randomness, we have a higher probability of success. So that is the first reason that we want to, study TA and learn to read charts and learn to read market generated information, because there are two participants in the casino. There is the gambler and there is the casino themselves. So even though the rolling of that roulette wheel might be totally random and it can, land in any, spot at any moment, and any person could walk up and make any bet they want at any moment, the casino uses the laws of probabilities to guarantee that as long as they keep having that roulette wheel spin again and again and again and again all day, every day, as long as more and more gamblers keep walking up and putting their money on the table, the casino knows they will win more than they will lose. They have no idea on any one roll of the wheel whether they will win or lose, but they do know that they have a guarantee over a high enough number of rolls that they will win more money than they will lose. That is what we try to do as traders, is we try to say, okay, let's use the technical analysis to make ourselves into the casino, where we may not know on this particular trade today whether it's going to be a winner or loser. We may not even know how much we're going to win, right? We may not even know how far the market is going to go, but we just know that over a law of probabilities, over a number of trades, 20 trades, 30 trades, 50 trades, if we always take this trade this way, it will work out in our favor most of the time, and we will make more money than we will lose. That is why I said this morning at the very start that I think the market's going to the overnight high today, but I wouldn't just go long right now to get there. I would need to see one of two things. I would either need to see the market pull back down to an asymmetric opportunity where I can just make so much off of my winner that it pays for every loser where the asymmetric trade doesn't work. Or I need to see a high probability opportunity where the market gets above the previous day's high, turns it into support. Then I know the odds of that trade working say that it will work more than it won't, right? I'm not just going to gamble. I'm not just going to go long right now because I think the market is going to go up. And like the gambler, I'm just chasing the emotional feeling of winning. Instead, I'm going to wait until I have a high probability opportunity. And so maybe it gets above the previous day's high and it finds support and I get long, and then it doesn't get to the overnight high and it comes back down and it takes me out of my long. Oh, well, who cares? Spin the wheel again. Give me another day where the market opens above the overnight high and or above the previous day high and finds support. I'll get in that trade again. That day, the trade will work. That will pay for today when it didn't work. Same thing with the asymmetric opportunity, near the lows. If the market comes down here near the halfback from Friday and I get long with a nice tight stop targeting the overnight high and it stops me out, I'm losing a few points today, sure. But if I take that trade again tomorrow and the next day and the next day, one of them will work out. And that one that will work out will pay for the last 5 that did not work out. That's asymmetry, right? These are how we have success in trading. Trading is not about guessing what the market is going to do. It's not about knowing what comes next. No one knows what comes next. It's random. It's a casino. You can roll that dice and it can land on anything. You can flip over that next card and it can be any card there. You never know. What you can know using technical analysis is where are the opportunities. Whether they are high probability opportunities or asymmetric opportunities, where are the opportunities? And if you only take trades where those opportunities are, you will have a much higher win rate. And most importantly, when you win, you will win more than you will lose when you lose. And that is how you get consistently profitable. Consistent profitability is not having a high win rate. It is not always being right on the trades you take. It is winning more when you're right than you lose when you're wrong. All of this and more is covered in my Mastery of Markets and Minds workshop. So if you guys are trying to take your trading to the next level, head to marketsandmind.com. Check this out. Consider signing up. As I said, if you buy it this week until Friday, and you use the promo code Bookmap, that is as cheap as you can get it. It's as good a deal as you will get. And this is a college level course on what do you actually have to do to be a professional trader. And hint, hint, it is not become a fortune teller. It is not learn to predict the future market moves with any sort of guarantee. It is simply understand where those opportunities are and then have the discipline and fortitude to only take trades when the opportunity is in your favor. And it ain't easy, and I'm making it sound super simple, but it is way more complex than that, which is why the course takes me 2 weeks to teach. Okay, so let's get back into today's market in the TA. We did not open with a gap up, which tells us what? What game plan are we playing this morning? It is a chop zone between the previous day's high, Friday's high, and the overnight low from the weekend. So in between these two levels, in between 64.20 and 64.08, there's nothing to do. We just let the market go up and down. That's a chop zone. We just let it chop. If we get below the overnight low and then we start to turn it into resistance, we are bearish for a pullback down towards 6,400. If we get below the overnight low and we don't get resistance and we come back up, we're bullish to come back to Friday's high and vice versa at the high. So for now, we are in a chop zone. Let's see which way it breaks. We're going to be watching the order flow on Bookmap to give us an idea of, is this just a quick little chop zone? Are we just going to spend a few minutes in here? Or are we going to spend hours chopping in here? How are we going to read that? First off, icebergs. Right now, it's saying chop, 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 chop. When you have an iceberg at the high and an iceberg at the low and an iceberg at the high and an iceberg, when you have icebergs on both sides of the market like this, that is a sign that it is bots artificially keeping you chopping around in a range. So that's the first thing that's catching our attention and telling us we're likely to chop for a little bit. The next thing we're watching is the order flow. How does it change? How quickly are they adding and pulling orders? What is happening when they get to them? Right? So if they're adding a bunch of liquidity at 64.15, what happens when price gets there? Does that liquidity fill and become resistance to push us back down? Or does it just disappear out of nowhere? By recognizing the changes in the order flow as they're happening second by second, we can have an understanding of who is doing business here and what is most likely to happen next. Being, are we going to break out of the chop zone or are we going to keep chopping? So there you go. We got to that first node of liquidity above and poof, it disappeared. Because it's a chop zone and that was just bots faking us out. So now what are they doing? They're adding liquidity below to try to turn around and bring the price back down. Because they're going to chop it up because it's a chop zone. Wow. Mark says, did you enter those levels on Bookmap yesterday or does Bookmap access them? Yeah, so it's, if you sign up for SpotGamma, then it just, you can plug it in. And so it automatically refreshes at 8 a.m. each morning and updates those levels for that day. So these levels don't change. These are based on the longer term, options data, not the 0 day. So these numbers don't change all day until 8 a.m. tomorrow morning. Then they update. If you want to see the changing intraday, you have to have SpotGamma's software up. We are the moon. That's a great name. We are the moon. Do, 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 do. We are the moon. He says, what is an unfinished auction or business? That is a great question. So think about an art auction, which is a one-way auction, right? How does an art auction come to an end? There's only one person left willing to pay. Right? The auctioneer starts at 1,000. I have 1,000. Do I have 1,100? Do I have 1,100? Do I have 12? 12. Do I have 13? 13. I have 14. Do I have 14? Do I have 15? I have 1,500. Do I have 16? Do I have 17? He just keeps taking the bid higher and higher and higher until there's only two hands going up. And then he's like, I have 1,900. Do I have 2,000? Sir, 2,000? 2,000? We have 2,000 over here. 2,100, sir? 21? 2,000 going once. 2,000 going twice. Sold to the gentleman over here for 2,000, right? So what happens in that process? First and foremost, the auction slows down. The tempo, the speed that auctioneer is moving significantly slows down, right? We can see that in the chart using time. That's why we look at TPOs. Where there's less and less time, that means there's less and less business happening at those areas. So that is support and resistance, right? That's where the market's running out of steam. There's no one left to buy up there, because they're really having to slow down the auction to get people to buy, right? And then the next thing we look for is volume. When is it that we get to that point that there's no one left willing to pay that higher price? And we can see that because volume tapers off at the highs. Okay, less and less volume. Right now, this current market has a taper in volume at the low and the high. So what is happening? We're pushing down. We're running out of sellers. We're pushing up. We're running out of buyers. So what are we probably going to keep doing? Pushing down and going up and pushing down and going up, right? So that's a good end to an auction, is when you push down, you slow down, you can't keep going, you reverse back up and you taper off the volume. That's a good auction coming to an end. Well, now let's say you don't get to do that. For example, if we look at the overnight high from the weekend, what do we see at the high? We got two letters right there. So that tells us we could have had another poke up. Somebody forced the market down there, right? Somebody didn't want to let us spend a little time at a higher price. So what does that mean? That means that's an unfinished auction. It means that there are people that went short right there that have their stops above there. And those stops are liquidity that the market at some point will come back for, right? That also means that if they can get up there, they might be able to convince more people to go long, right? They might be able to, that might change somebody's mind. somebody who's not confident enough to go long right now at this moment, if they see the market get all the way up above that overnight high, they might start to chase price up there, right? So that unfinished auction tells us that if the market can get up there today, it can do business. And that's all the market wants, right? We talked about this last Monday on this very stream. The market is a shark. It's hungry. It's just smelling for blood. Where is the blood? Where can it fill orders? Right now, the blood is by staying inside this box and going up towards the top and coming back down towards the bottom and going back up towards the top, because each time it does that, it's squeezing traders. It's first thing in the morning. Everyone's got their opinion. They think the market's going to go higher or lower today and they want to get in a trade. So they're forcing their way into the trade. So if the market goes down, it can get those sellers into their trade, right? It can get them to, oh my God, it's going down. I'm right. I got to get short. I got to get short. And then they get short down near the lows. So then if it turns around and comes back up, what are those sellers going to do? They're going to become buyers, right? They're going to get stopped out. And so it comes back up and it stops out those buyers. Well, then you got people that want to get long and they're like, oh, fuck, I missed it. That was the low and I didn't go long. Oh no, I got to get in. So they start chasing price up at the upper end. So what does that shark do? If he turns around and swims back down, he's going to stop out all those buyers from the upper end. And as long as that keeps working, maybe it'll work for 5 minutes. Maybe it'll work for 5 hours. As long as chopping up and down and chopping up and down and chopping up and down keeps getting people long and stopping them out, getting people short and stopping them out, that shark is just going to keep swimming around inside that chop zone and eating up that liquidity. But what happens if that stops working? What happens if the shark swims down and nobody really goes short? The people are no longer confident. We've been down here 10 times and they just give up. And they're like, I'm not going to short this again. All right. Well, then what if it comes back up? Well, now there's no liquidity there to take out those shorts. So then what does the shark have to do? He has to go explore new waters. He has to go look for fresh blood. Where is that next spot? Above Friday's high. That's the first place where you start to squeeze sellers from the overnight and from Friday, and you start to bring in FOMO buyers from today. So the shark swims up there and he gets above yesterday's high to find out, yum, 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 how much food is there up here? Now, if there's a lot of food, if he keeps bringing in buyers, more and more food up there, he's going to swim up higher, looking for even more food. If he swims up there and there's no buyers up there, he's going to swim back down again, looking for food at a lower price. That is the auction process. It is the market's way of going up to see, will going up get people to fill orders, or will going down get them to fill orders? And if it goes up and it does fill orders, it's going to keep going up. And if it goes up and it can't fill orders, it's going to turn around and come back down. So what we have to be obsessed with as traders is, where are these levels where this stuff happens? Where are the areas where orders are going to fill if we get there? Now, one great tool is the Bookmap, because it shows you where there are currently orders sitting in the order book waiting to get filled. You better believe that shark can see these orders. He knows where they are. But there's more to it than that, because not all liquidity is visible in the order book. Some liquidity is in stop orders. And stop orders, you can't see them until the market gets there. That's what a stop order is. Your broker holds on to that order until price gets to your stop level. Then your broker puts the order into the order books. So the shark has to be smart enough to know that even if he can't see liquidity above yesterday's high, there's stops there. And if he can get up there, he can take out those stops. And so that's what we obsess over as traders. Where are these levels where people can get stopped out or people can FOMO in, right? Where are these levels where the auction process changes, where the shark no longer has to go up and down to fill orders, but he's got to start heading in one particular direction to fill orders? And if you can learn to read the market in that context, you can find those high probability opportunities that we talked about before. marketsandmind.com. I'm telling you, if you don't know this stuff, you are just blindly entering trades because one line crossed another line. And that shit is random. That's like sitting at the slot machine and just putting in another quarter and just pulling on that slot machine over and over again and just hoping and praying and wishing that you're going to get lucky and it's randomly going to be your number and you're going to make a fortune. And that's fine. And it's a lot of fun. I'm not saying gambling isn't fun. Trading is a lot of fun. It's exciting. It's a thrill. But if you're chasing that thrill, if you're chasing that feeling, you will probably lose more money than you will make. After a week or a month or a year or 5 years or 10 years, you will look back and you will realize you lost more than you made. If you want to make more than you lose, you got to become the casino. You got to stop chasing the feeling of winning money, the excitement of it, and you have to start chasing probabilities, a statistical edge that you have proven works. That's what you're after. Of course, that's what I teach in the workshop. Because it's a chop zone. So you say to me, okay, Charles, I hear you. What are other little edges that we can use to recognize changes in the auction? One excellent tool that Bookmap provides is this stops indicator. So you can program it, the settings, however you want. I've got mine set up so that it has to be at least 10 stops or more that get taken out at a particular level. Otherwise, it just doesn't interest me. So that's 10 stops from one account. Like somebody who was trading more than 10 contracts got stopped out. That's when those stops jump up on my screen. Okay. Because I want to know not just where is every Joe Schmo getting stopped out. I want to know where the bigger players, the people that are playing with 10 plus contracts at a time, where do they get stopped out, right? And when you start to recognize that, that is often where an auction process ends. So for example, we poked up to test yesterday's high. We didn't stop out any sellers there. So the market came back down. Okay. We took out somebody who went long. Somebody saw the market pushing up and was like, I got to get long. I got to get long. And they used a really tight stop. This is obviously some sort of scalper, right? They had a really tight stop. Market came back down. Yum, 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 yum. Ate up their 13 contracts. Now what is it doing? Heading back up for yesterday's high again, right? So when you can see these things happening in real time, it doesn't necessarily mean there's always a trade to enter, but it just means you understand what is happening within that auction process, which is what sets you up for those high probability opportunities. Inside the chop zone, back to the previous day's high. You say to me, Charles, this is so much stuff to remember. I got to watch how the order flow is changing. I got to watch the price action. Where is volume and time tapering off? I got to watch this. I got to watch that. It's so much. Yes, it's so much, right? If you wanted to be a brain surgeon, there's a lot you have to learn, right? You have to go through a long and arduous process of learning for decades before you can start performing brain surgery. If you want to be a professional athlete, sure, the game of basketball is very simple. You dribble, you shoot, you pass, you foul, you defend. These things are simple. But to get to a point where you can do it as a professional, where you can make ridiculously good money doing it, takes years and years and years of honing those skills. That's what trading is. It takes years and years of honing the skills before you make that brain surgeon money, before you make that professional athlete money. And that's fine. That's okay. As long as you're not wasting those years of your life. As long as you're not just letting time pass, treading water, doing the same shit over and over, even though you're not getting any different results, right? As long as you're not doing that, it's fine. You travel on the path as long as it takes for you to get to the point where you can start making great money. How do you know you're on the right path? You take the Mastery of Markets and Minds workshop. So that I can tell you how to know if you're on the right path or not every step of the way. Inside the chop zone. It's so choppy, very choppy. They are squeezing the traders on both sides. Tom in the house. Arg! Good trading, me hearties. Willie T is here. Good morning to you. Zach says, why not take an entry at 64.10? You can. You absolutely can. The thing about it is, if I was going to take an entry at 64.10, I would rather take it after the market dips below the overnight low, and then it's on its way back up. Now, I'm not saying there's anything wrong with putting a limit order in there. You know, you're recognizing previous support from Friday. You're recognizing that the auction tapered off over the weekend. And so you're saying, look, I'm just going to put my buy order right there. I'll use a nice tight stop. And, I'll put my take profit at the previous day's high. My risk is less than my reward. It's a good trade. Let me jump in that trade. There's nothing wrong with that. Just me personally, the way I trade, the one thing I don't like about that is I have no way of knowing whether it's going to work or not. It's a guess at that moment whether it's going to work or not. Okay? Whereas, let's say we want to take the same trade, but instead of just putting in the limit order and letting it fill as the market pushes down into that level, we watch the market poke below the overnight low first. Okay? Then the market comes back up and it does not turn it into resistance. Then the market starts to push higher and it pushes back through 64.10. Now I get into that long trade. The fact that we looked below and failed the overnight low, the fact that the shark swam down there and couldn't find any food, significantly increases the odds that it's going to swim up to the high. So now the probability of that trade working is significantly higher. Okay. I can also, this may sound confusing, but I can also have a better stop, because at that moment, after the look below and fail, putting a stop below whatever that current low is a very good place to put the stop, because the trade will either work and it'll head back up, or it won't and it'll stop you out. And if it stops you out, if it comes back down through that low again, it's going to sell off much lower. Whereas if you entered the limit order and you're not sure exactly where it's going to reverse, so say you just put the order at 64.10 and you were like, I'll put my stop at 64.05. You're just trying to figure out where it'll reverse. It might come down, get just below 64.05, and then come back up. So if you can have the discipline to wait for the failure first, you know where that low is. The market information has told you where that low is. You're not guessing where that low is. And so these are the slight adjustments that you make that give you a better edge. Now, everything in trading that gives you an advantage has some sort of disadvantage tied to it as well. That's just the nature of markets. What is the disadvantage in this case? You may not get the look below and fail. The market may come down to 64.10, and then turn around and head back up and never come down again. So by waiting for the failure to get into the trade, you miss the trade and the trade goes without you. So that's what you have to decide. Do I want to get in the trade, having uncertainty about the probabilities of it working or not, and uncertainty about exactly where to put my stop? Or do I want to risk missing the trade in order to have a very high probability the trade will work and to know exactly where to put my stop? Now, in my own experience as a trader, if we're talking about a series of trades, if we're talking about 10, 20, 30, 40, 50 trades, I will always have better results by being patient and waiting for those higher probability opportunities rather than impatient and just wanting to be in every trade and taking the trades where I'm doing more guessing. Now, that means some days I have to have a lot of discipline. I have to let a trade that I thought the market was going to find support and go higher, I got to let the market go higher without me. And I just have to sit and wait till that next high probability opportunity comes, which would likely be, in the case of this example, support at the previous day's high. You know what I mean? And that's just, it sucks. It sucks sitting around guessing the market's going to go up and not being in a trade while you watch the market go up. But again, over the series of trades, it's the better way to do business. Inside the chop zone. That is literally why I invented the term chop zone, to describe what it is. A chop zone is an area where I don't have a statistical edge, where it could go up or down at any moment, and I don't know, and I'm guessing, and we'll have to just wait and see. If that area exists on the chart, I want to tell myself I never, ever, ever trade in that area. I wait till we break and either have a successful breakout or a failed breakout. That is where I do business. And then that makes it easier for me to handle if we spend 30 minutes going nowhere. I mean, we're right back at the opening price. We've gone nowhere for 30 minutes. And in this very room, listening to me right now, there are probably traders that have taken 10 trades already today. And maybe 3 of them were profitable and 7 of them weren't. And they're exhausted and their brain is dead. And the market is going to make a big move today and they're not going to be in it, because they burned themselves out in the first 30 minutes taking trade after trade after trade after trade, because they're the gambler. They're chasing that feeling. They're not chasing a statistical edge. Inside the chop zone. Intraday Predator says, if you're not familiar with market profile, where do you recommend a beginner start? Well, I made the Mastery of Markets and Minds workshop specifically for beginners. Okay. So that's what this is. It will teach you everything you need to know about market profile, about the auction process, about Bookmap, internals, everything. All the stuff that I use in my trading will be covered, including my setups that I trade. And how I trade them and why I trade them. And probably most importantly of all, even though people don't really think about it, the process that you go through to develop your skills as a trader. That's really what most people don't understand. How do you recognize your own personal strengths and weaknesses and develop your system based on you, your psychology, your brain, the way you process information? That is more important than reading a chart. Anyone can learn to read a chart. That is not going to make you a profitable trader. Learning to understand your own strengths and weaknesses and develop a system custom tailored to you, that is how you become profitable as a trader. So that's what this workshop is all about. If you're looking for something like a little more, affordable, if you don't want to spend right now, if you buy it with the discount and the promo code, it's only like $300. But if that's too much money for you, I recommend Jim Dalton's books. Markets in Profile is a good one. And that's just going to cost you like $50. But in the end, the best way to learn how to trade with Market Profile, once you know all the terminology and all of that stuff, you've got the basics down, is to sit and watch the market move through this lens all day, every day. And let your brain build a neural network for understanding what's going on. It's not something it's like saying, if I wanted to learn to be a great quarterback, playing football, what course should I take? What book should I read? It's like, you can read books, but really you got to get out on the field and throw the football while you have linebackers running straight at you over and over and over again. You got to build that skill in your brain for making decisions under pressure in real time. And that's really how you get good with any type of trading, but in particular, the auction process is you got to do it in real time to understand, what you're going to do and not do. It's great to back test and see how often a market looks above and fails the previous day's high, or how often you fill a gap, or how often you this or that or whatever. That's great. But will you be able to pull the trigger and take that trade on the day? Because that's all that really matters. And so it just takes practice. If you're willing to commit to putting in the time to gain the skill, you will gain the skill. Malcolm says, my trading path was typical. Lots of rooms, roads, and struggles. Charles's training is the best value on the web. Invest in your education. Thank you, Malcolm. Appreciate you. That was the goal. That has always been my goal, honestly, since I started Pirate Traders. is just try to help other people not have to go through everything I had to go through. Because I too went down every rabbit hole there is in the world of trading. I traded every market on every time frame. I tried every piece of TA that exists. I paid for many different rooms and trading signal services and all that shit. And none of it ever worked, not consistently. You'd get lucky from time to time and make a bit of money here or there. But to be able to consistently get results over and over and over again, you got to just glue your face to the screen and put in the time. And as long as you're on the right path, as long as you're doing it the right way, you will get to success. And so that is what I always try to teach. If you've been enjoying this this live stream, you might consider joining the brigade. There's a link in the description. That is a group of traders that hang out together every day for the first hour with me and talk about markets. So if you've been enjoying this, you should join the brigade and do it every day. If there are any questions that I missed from the Discord, I will go back in and answer them after the fact. I will write out the answer to you guys. For the rest of you, thank you so much for joining. We will see you next week. Members of the brigade, let us set sail. I'll see you in the live stream in about 2 minutes. Thanks, everyone. Have a great week. Let me give you, you're like, Charles, but what's going to happen today? So I am still in the exact same place I was at market open. I am bullish. I think we're heading to the overnight high. There are two ways to trade it. Wait for the market to find support somewhere where I can get in with a good entry, or buy support at the previous day's high, which it looks like we might be testing right now. If the market can get above Friday's high and turn it into support, remember, we got a call wall here right at 64.23. So we are going to grind for a while in here. Okay. There's going to be options market hedging that starts to take place here. We're not going straight to the overnight high. So let the market push up, let it grind. If it's finding support, then you think about getting long to get to that overnight high. Okay. Good luck. Happy trading. We'll see you next week.